The Fed just signaled something major for 2023, and I'm going to bring that information directly from them to you. My name is David Quintieri, and what I do on this channel is look into the intricacies of the economy and the markets, and I make it real simple for people to understand. I'm trying to find out the truth, and I bring that to you. In today's video, we're going to look at what the Federal Reserve has done and what that signals for 2023 into 2024. And let me tell you, I'll give you a little hint. It looks like the Federal Reserve is not done increasing interest rates. At least that's what they're saying. This would impact you directly. And of course, the bond market is yelling and screaming that we've got a problem. I'm going to show you all of that right here and now. How does that sound? Let's get into it. Fed leaves rates unchanged, sees 2 small hikes by the end of 2023. That's the big news. I'm giving it to you right up front. I will give it actually from the source itself, but I want to see what you had to really think about this, because for a lot of people, they were believing not only would the Fed leave rates, they would actually be cutting at this June meeting. That didn't happen. They didn't cut, but they have basically decided. He made a specific note to say this is not a skip, because all the articles are saying skip, the reporters are saying skip. He's saying, no, it's not a skip, but we are simply making this decision at this time, and we're going to run with it for now. I got more to show you. Look, Powell says that inflation risks remain as the Fed pauses hikes. It's too soon to say that inflation will continue to retreat, even as officials expect price pressures to stay on a cooling trend. They are expecting it to go in this direction. How long would it take the Federal Reserve to start cutting rates? That's really the question. And for so many, September is when they believe they're going to cut rates. So if the Fed is saying something different, well, then the market expectations are off. And then what does that mean for stocks? Stocks do not believe at all that there's going to be any more tightening. That's very clear. That was seen in this particular session in the markets. Let me give you more detail. Fed holds off on rate hike. In the highlighted portion, it says, holding the target rate range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. Essentially saying that we leave it here, we see what happens with inflation, with the jobs and so on, and then at the next meeting, we'll decide, do we do another one? Okay? Breaking it down, this is actually really good stuff because it shows you the quotes. Always what happens is at 2 p.m., the Fed meeting is basically the Fed statement. It comes out, the Federal Reserve will make this statement, and then the markets will react directly to that. They say, are we increasing? Are we decreasing? What's happening with quantitative easing, quantitative tightening, all that stuff. That's 2 p.m. 2:30, the reporters have a chance to actually have some communication with the Fed chair. In this case right now, it's Jerome Powell. And so they go back and forth a little bit. And you know, that statement is so manicured. It's so like perfect. However, at that 2:30 interaction, sometimes you get a little bit more detail. And in this case here, I'm going to show you something I think you better pay attention to. Here we have it. It will be appropriate to cut rates at such time as inflation is coming down really significantly. And again, this is the quote, we're talking about a couple of years out. As anyone can see, not a single person on the committee wrote down a rate cut this year, nor do I think it is at all likely to be appropriate. You see what he's saying here? This is big. This is important. And why? Because the market is expecting September rate cuts, and yet Jerome Powell and every voting member of the Fed is saying not even close. So you tell me what that means. Is there a recession or terrible depression that's coming and they'll have to cut rates? Or is it just miscommunication? What is it all about? All right. The central bank hasn't made its decision about the next month's policy moves, but that it came up in the latest meeting from time to time. Of course, they're calling it that. As they say here, the skip, I shouldn't call it a skip, the decision. So he's trying to be very clear about that. And that's one thing about the Federal Reserve. Now, the market came down as a result of this. Market starts coming down. Uh-oh, you saying 2 more rate hikes. Whoa, whoa, whoa. What's happening here? And then it bounced back up. Because let's be honest here. The markets know that that isn't today. It's not tomorrow. It's not even next week. So let's just go all in. What did they go all in on? Can you take a guess? I'll show you at the end of this video. But if you want, you can take a guess. Put it in the comments below. What were the type of stocks that have been doing well at this very moment on this trading session? What do you think it was? You don't have to think very hard, but let's just talk about that. Okay? I'd really like to know what you think. I love these guessing games. Well, the last time I did one of these, there was like 100 comments just on the guessing. So let's see what we got. You could see the statement says we're not done yet. Clear communication of more rate hikes are coming. No capitulation on the idea that the Fed wants to see an economic landing, whatever that means. And I think he meant sort of a tough landing, but I'm not sure what they're saying there. I think it's important to look at what's next. You got to know this. You got to feel what they're saying, what the market is expecting, understand the economic data that's coming through so that you can make a decision for yourself, okay? The median estimate of the Fed's participants' projections is now for rates to rise to 5.6% by the end of the year, implying 2 more quarter-point increases. That would be up from 5.1% in March. So we don't know, of course, but that's what they're saying, and I can show you that. This is called a dot plot. And really, it doesn't mean anything, to be honest with you. Even the Fed says that. But what it shows us is 2023, 24, 25, and longer term, where the FOMC believes that the interest rates will be. That's like a guess, totally a guess. It's not a bet. It's not a decision, nothing. But that's what they're saying. And these people are in the Fed, okay? And so you can see it right now, 2023, the vast majority of them are putting us at 5.6%, all right? And then you could see that 5.4%, and basically just shows you on the chart. Going into 2024, it starts to get a little bit less clear, but most people for the remainder of the year in the Fed believe that the Fed funds rate should be at 5% or higher, 5.1, I guess that would be. All right, then we go to 2024. The average is 4.4%, somewhere in there, 4.5% maybe. And then you look at it in 2025. Longer term, the expectation is 2.5%. That's their favorite number. That, of course, the next recession, I believe they'll just cut it all the way down to 0 again. So 2.5 is nonsense. But that's what they're saying. So think about that. Think about what this means for the bond market, about mortgage rates, about all these things. If we can expect that there's another 1 raise or 2 this year, what are mortgage rates going to be at? 7.5%? 8%? I'm not sure, but that would be yet more because it's just dragging on. It's not a problem necessarily if rates were to go up, they stay there for 6 months, okay, they come back down. If it stays there for an extended period, that becomes entrenched. That adds to the difficulties, and inventory has a chance to climb, and then that's where there's an issue. That's really what it has to be there for an extended period. Foreclosures are an issue. Commercial real estate, though, is really the one. And that's, I think, a much bigger problem than the residential, as I've said before. Commercial real estate, of course, has spillover effects into the residential. I think some people are confused about that, but the way that this works is there's a lender. There's a lender. If the lender is affected, then that has an impact on all these different things, as we saw during the financial crisis. Nobody even realized all the insurance like AIG and so on, how that could tumble all the other companies, the markets themselves get tangled up into it. Companies are just going bankrupt. Companies that were considered to be strong were going bankrupt. I don't think people realized that cascading effect. This is just a statement from the Federal Reserve about all the different activities. You can pause it or go to the links in the description under the sources. All you need to know, they've kept their rate the same as they expected. I talked about that before anyway, that they suggested that they would pause. People said no, that wouldn't be the case. But anyway, no worries. AI proves mightier than the Fed for stocks divorced from the economy. So if you guessed AI stocks, or less specifically, tech stocks that did well, well then, you guessed right. Congratulations, Janet Yellen will pay you a personal visit, okay? So for anybody that guessed tech stocks, or more specifically AI, I'm gonna have her just pay you a visit directly to your home. We'll let Janet know, and then she can visit you. Congratulations. But that's the way it works. You have the highest risk, and you see this very clearly, that there is no sense. This makes no sense. What has happened? I mean, look at tech stocks, how much they have surged. NASDAQ 100 has added more than 30%. To anybody that's been paying attention to this channel, back in September, I said, it looks like the market's going to be bottoming out in October. I based that, I think 2 different times I said this in a community post. Okay, so like the blog section of YouTube. And then I also was mentioning in the videos around that time, based on both the technical analysis, but also a lot of those inside the financial world were saying that. Now, what I was basically saying, to make it clear, was this looks like it could be at least a near-term bottom. Like, I don't know what's going to happen 6 months, a year down the road, because they're not pumping money in, but it looks like right here, this near-term bottom. So here we have it, and it's clear that that is the case. As of October, markets have just been going up, and they've been doing it defiantly against the general conditions, right? However, this has been like the weakest recession in terms of their indicators. Like, the unemployment is super low, the jobs are so-called good, all that stuff. And so, in that regard, it's considered to be a weak recession. However, the yield curve inversion, like the #1 indicator, is like strongly in support of upcoming recession. So I think that is what we've got to know, we got to face. You've got to check this video out so that you know the direction of the markets. It's very important. And that is, just go to the YouTube search and type in 60 seconds, the money GPS. 60 seconds, the money GPS, and I'll see you there.